All right, let's get right into it. There's this massive, unavoidable question hanging over the entire U.S. economy. And how it gets answered, well, that's going to directly impact your money, your savings, your retirement, the whole 9 yards. The problem? The smartest people on the planet can't seem to agree on how this story ends.
It all kicks off with this number, 131%. That's the projection for where the U.S. federal debt is headed as a share of the economy by 2036. And here's the kicker. Literally every single expert, no matter their political stripe, agrees that this path is completely, totally unsustainable.
So, if we all agree the train is speeding towards a cliff, the billion-dollar question is, what happens when it gets there? Does it crash and burn, or does someone pull the emergency brake? And this is exactly where the experts split into two very different camps, each with a very different ending for your financial future.
So here's our game plan. First, we're going to tackle the one thing everyone agrees on, the debt problem itself. Then we'll walk down the two possible roads ahead, inflating the debt away or facing a more controlled default. After that, we'll get into the fascinating reason why the experts are so divided, and we'll wrap up with what really matters, what this all means for you and your savings.
Okay, let's start on some solid ground. In a world full of heated economic debates, the fact that the U.S. has a serious long-term debt problem is one of those incredibly rare things that everyone just nods their head to. It's a consensus.
And this timeline really lays out the trajectory we're on. I mean, think about it. Today, our national debt is already about the same size as our entire economy for a whole year. But it's not stopping there. It's projected to just keep climbing, meaning this problem is actually accelerating, getting bigger and bigger, faster and faster every single year.
Which brings us to this fork in the road. These are the two competing theories for how this all plays out. On one side, you have the soft default. This is where the government basically just prints money to handle its bills, which leads to high inflation that quietly eats away at the value of the debt and, of course, your savings. On the other side, you have the hard reset, a much more direct hit with things like painful tax hikes and big cuts to government benefits.
So let's dig into that first scenario, inflating the debt away. A lot of people see this as the path of least resistance, politically speaking. I mean, it doesn't require any tough votes on raising taxes or cutting popular programs. And that's exactly why some experts are convinced it's the most likely way this is all going to go down. Now, to really get this, we need to talk about a concept called fiscal dominance. It sounds kind of academic, but the idea is actually pretty simple. It's when the government's need to borrow money becomes so huge that it basically bullies the central bank into keeping interest rates low. The bank is forced to help the government finance its debt keepy, even if that means letting inflation run hotter than it's supposed to. We actually saw this play out after World War II when countries held rates down on purpose to manage their massive war debts. They just accepted higher inflation as part of the deal.
So you see the logic, right? The thinking is that politicians will always choose the slow, quiet pain of inflation over the loud, immediate political pain of austerity. It's a way to shrink the real value of the debt without anyone having to cast a really unpopular vote. So what's the price? Well, the price is a long, grinding period of maybe 4, 5, or 6% inflation, which is basically a hidden tax on every single person holding dollars.
All right, now for door number 2. This theory is a much more direct, much more abrupt kind of adjustment. We're not talking about a slow burn here. We're talking about ripping the Band-Aid off. And when we say default, you got to understand, it's not just about the U.S. government literally missing a payment on a treasury bond. Pretty much everyone agrees that's not going to happen. No, this is a much broader idea. A default is any situation where the government fails to pay what it promised, whether that promise was to a bond investor, a retiree waiting for a Social Security check, or a taxpayer expecting certain services.
And this kind of default can take a few different forms. And spoiler alert, none of them are fun. We're talking about sharp, sudden cuts in government spending, abrupt, significant tax hikes, big reforms to programs like Social Security and Medicare, changing who's eligible or how much they get. It could even mean something called financial repression, where the government basically forces big investors, like banks, to lend it money at super low rates.
So we've got these two very clear, very different potential futures laid out. Why on earth can't the experts just look at the data and pick one? Well, because the answer isn't buried in a spreadsheet. It's about people. It's about human behavior.
The whole disagreement really boils down to 3 huge unknowns. First, political will. When the pressure is really on, will politicians actually make the tough, unpopular choices? Second, Fed independence. Will the central bank stand its ground and fight inflation, even if it gets immense political pressure to do otherwise? And third, market tolerance. How long will investors around the world keep lending the U.S. money at low rates before they start demanding more? How you answer those three questions determines which path you think is more likely.
Okay, so this brings us to the most important part of this whole conversation. Let's forget the high-level theory for a second. What does this fork in the road actually practically mean for your personal finances, for your wallet?
And here's where the rubber really meets the road. Look at how each path hits you differently. In a high-inflation world, the cash you have sitting in a bank account gets its purchasing power crushed day after day. But hey, your 30-year fixed-rate mortgage suddenly gets a lot easier to pay off. In a controlled default world, your cash might be safe from inflation, but your future Social Security benefits could be cut, or you could get slammed with a huge tax bill. There's really no easy way out.
And this chart just visualizes that dilemma perfectly, doesn't it? It shows how your traditional, safe money is in the crosshairs no matter what. Path 1, high inflation, just directly erodes its value. Path 2, a default with financial repression, crushes the returns you can get on it. Either way, it becomes incredibly hard to actually grow your wealth.
So what are you supposed to do about all this? Well, here's where the experts, after all their disagreeing, actually start to come back together. The consensus advice is surprisingly straightforward. Don't try to guess the future. Don't bet on one outcome. The smartest move is to build a financial life that is resilient, one that can take a punch no matter which path the country ends up going down.
And this is what that resilience looks like in practice. It means not having all your eggs in one basket, diversifying your investments outside of just the U.S. economy and the U.S. dollar. It means owning some real assets, things like real estate or commodities, that tend to hold their value better when inflation is high. And maybe most importantly, it means planning for policy risk. Just assume that the government's promises about taxes and benefits are probably going to be less generous in the future than they are today. And all of this brings us to our final question. In a future where there's so much uncertainty, where even the experts can't agree on what's next for the world's biggest economy, maybe the only asset you can truly rely on isn't a particular stock or bond, but your own financial resilience, your own ability to prepare and to adapt.